Hi everybody, today is Saturday, it's the 19th of July, and this is Brian Shannon speaking from alphatrends.net. Let's take a look at the market this week. I was out the last couple days and will be out Monday and half day Tuesday as well. So let's take a look first at the numbers here. We saw the S&P 500 was up 0.5%, NASDAQ up 0.9%, Russell 2000 continues to be the laggard, now down about 1% this year. And again, that shows why, if you're going to trade the Russell 2000, trade it based on what the Russell 2000 is doing. If you're going to trade the SPY, base your trades of the SPY based on what the SPY is doing. Don't look at the Russell 2000 and say, well, the Russell's down, so therefore we have to be short the S&P 500. Those relationships simply don't always exist. Trade what you're trading, manage risk on the stock or the ETF that you're trading as well. It was a good week for oil. That's bouncing back here a little bit as well, and bonds came back once again too, now up 12.5% year to date. So let's look at the charts and make some sense of this. As we know, we've been a little cautious on this market, and someone actually criticized me last week saying, Brian, you're cautious at the bottom, you're cautious in the middle, you're cautious at the top. And I think that person made some assumptions that they knew exactly where the bottom was, they knew where the middle was, and they knew that where the top was. Because I certainly don't know where the top is, if this is a top or not. I know this: risk management is job number one. There is risk in the market every single day. This risk on, risk off stuff is really complete nonsense. There's risk every single day that you're in the market, and our job is to manage that risk and take what we could perceive as the low risk, high probability trades. If the market tells us that we're wrong, then we move to the sidelines and wait for things to reset up. And right now, we've been kind of range bound in this market. We're riding this trend line. This is the most relevant trend line right now that I can find in the market. You could also look at this and say, well, what about that trend line, and which we broke? But we've got this market, which is still controlled overall on the bigger picture by buyers. So we're still, obviously, on the weekly time frame, innocent till proven guilty. There is absolutely nothing here that convinces me we're at a top. What would convince me is if we start to roll over, we make lower highs and lower lows, and then we're below declining moving averages. We don't have that yet, so consolidations are innocent till proven guilty with a longer term uptrend. And when we see choppy action on the intraday charts, it says turn sideways. The market's turning sideways. Focus more on individual stocks and managing risk. Next week, we're going to want to see really about 195 hold as support for the S&P 500. As long as we're above 195, then we're neutral, intermediate term with longer term uptrend, and we need more evidence from the market before we decide to make major commitments. If we can get back above and hold above really about 198.25, then perhaps this market can continue to move higher. The path of least resistance overall is still higher, so we're cautiously optimistic because of the primary uptrend. The same goes true for the NASDAQ. The NASDAQ had a decent week. There was volatility, of course, and if you're reactive to headlines, then you saw that, of course, Thursday we saw a big sell-off and intraday and closed on its lows. I got some people telling me emails that this is now the top. We definitely have a top, and it's just kind of foolish. I often send back an LOL, just manage risk, because that's what we have to do. One day's pullback, regardless of what the news is only one day pullback until we have more evidence of that trend being broken, and we don't have it. If we can get back above 96.25 and hold above 96.25 next week, then we're going to see new highs again here in the NASDAQ, and we came down and touched once again upon this trend line and that rising 20-day moving average. So for the last 3 weeks, you can see very clearly there have been buyers at that rising 20-day moving average. So if we break below that next week and hold below it, perhaps we're going to turn more sideways in a corrective mode, or perhaps pull back deeper. But this is a very good reference line to compare price to, and that's the value of moving averages. It's a reference point, a tool to compare price to say, is it behaving and is it following some structure here? And the structure is, yeah, we've got buyers at the rising 20-day moving average. Sellers slow down at the rising 20-day moving average. For those people who say that there isn't an element of self-fulfillment in technical analysis, you need no more than to look at a 20-day moving average or a 5-day moving average and see how buyers and sellers interact with that. So next week we're going to want to see that 20-day moving average hold. That's the key. And if we break beyond these highs here, then it's looking like continued higher highs. So the market remains in good shape. We are in earnings season. There's going to be disaster stocks, and there's going to be good reactions as well. This, one stock that was in a fantastic uptrend, SanDisk, got hit hard on earnings. Then, so there was risk on in that stock. Microsoft, we've been talking about this one as being a good longer-term investment because of the longer-term chart. I personally haven't been involved in it beyond some trades a couple months ago, but I've been consistently saying that the path of least resistance is higher. If you have more patience than I do, then it's a good investment, and it has been a good investment. I have no hard feelings about not being involved in this type of move because it doesn't suit my personality to be involved in a stock like Microsoft waiting. And you have to realize that every single stock that you see out there that someone mentions, you have to do what's right for you in that, and you're going to miss some good opportunities, but it's better to be disciplined and miss some good opportunities than to be reckless and just be chasing stuff left and right and losing a lot of money, because that's what happens to the people who do chase like that. The Russell 2000, as we know, we've been looking at this Fibonacci. We thought that there was the possibility the market would find support. We thought that this is a high probability level that it would find support. So we were anticipating a turnaround because it was a 50% retracement of this range. It was where we saw the rising 50-day moving average, and it's where the volume weighted average price year to date, that's that orange line, resided. So as I was saying, we anticipate in here, but when we have a declining 5-day moving average, we do not participate. So despite the fact that it looked like a likely area of support, there was no advantage to being a buyer in there, and I was very clear about not being a buyer in here. Now maybe next week, back above about 115, we'll have this market back above the 5-day moving average and above some near-term resistance. So I would keep an eye on 115-ish for the Russell 2000. If it can move beyond that, you can see we caught some buyers here at the 61.8% retracement, but the intermediate term still declining 5-day moving average. So what we want to see is the market rally up, find support at that 5-day moving average, and then perhaps we'll be in a position where it can continue to bounce a little bit. And I apologize, but for some reason the charts do that when I'm on my laptop and I'm out of town here. But back above 115 in the Russell 2000, I think that it could be a decent purchase. And initially, I think a stop would go at about 113.40. You do have to realize, though, that we've got a declining 10-20 day moving average, and the upside may be limited, but back above that 115, perhaps we can rally up towards about the 116.5. I don't like it as much over here as I did back here a month or so ago, but it's a candidate for a bounce. That's it. This market is guilty till proven innocent. It's had a real rough time this year. You can make a case that maybe this is longer term distribution, but the fact is we simply won't know if it's distribution until after the fact. If it breaks back below 110, then it declines, then we can say yes, that was distribution. For now, we're saying it's just choppy action. We don't have enough evidence to say what it is, whether it's going to be a big top and it collapses, or whether it's consolidation before building some energy for a new move higher. We're not trying to predict. We're trying to look at it and say, while it is kind of crazy back and forth action like this, we have to shrink our time frames down for a trading perspective and then wait for the market to give us the evidence. We're not predicting, we're managing risk and saying, let's trade the Russell 2000 based on what the Russell 2000 is doing, not based on what we think it should do in relation to the S&P 500 or in relation to bonds or whatever. The semiconductors, again, this group was up this week. Let's take a look at the number. The semiconductors were up this week, just 15 basis points, but still, they were up this week. They're up close to 19% year to date, and no one has been able to correctly pick the top. Maybe a couple people sold it this day, and they're still short. But we've got this trend line you can see here over the last month, and we've got this prior resistance, which has been tested as support. So this is the key level right now in these semiconductors, $49.50 to 60 cents. If we can maintain above that, then the buyers remain in control of the semiconductors, and it's just kind of dumb to be short unless you're looking at it from a very short-term perspective. And even there on the 1-minute chart, you can see the buyers had regained control. The financials are still kind of neutral in here, and they're above a rising 50-day moving average. They've been holding that, but they're just kind of back and forth in here. Overall, primary uptrend still intact. Listen to the message of the market, not to news headlines in here, but we're just neutral near term unless we can get back above and hold above 23 to 23.05. Let's take a look at gold here. Again, this is, I talk about all the time about how I don't like to trade gold because of the gaps, and we saw that, going into this week it looked great, but then it gapped way down, and then they got a gap up and gap down. I still think that for gold, longer term, we're neutral at best. Perhaps we're building a base on this weekly time frame, but it's, you're in a range that seems to be tightening, and really there's no advantage to being involved in gold. Bonds had a great week here. They are at closing highs for the year, so the bond market continues to defy what skeptics think it will do. Don't trade bonds based on what Janet Yellen says. Don't trade bonds based on what Bill Gross from PIMCO says. Trade bonds based on what the price action is saying, not what one or two influential people are saying, but what is the consensus of the market. We saw a week ago that the market looked like it was in jeopardy of breaking down, but from that failed breakdown came this fast and vast move higher. So the bonds are still in an uptrend. Yields are lower. That's good if you're long bonds, and it's terrible if you're one of the many people getting squeezed short. The shares of Apple, we came in this week thinking perhaps it can continue to 100, and we got involved over here and stopped out for a 20-cent loss. And again, a 20-cent loss, it was the right thing to do, because otherwise you could have been down a couple dollars in that one. So I think that Apple needs to spend some time up in this area. Eventually it looks like it makes an assault at that 100 level, but for near term, it's just kind of dead money. And the volatility index, let's talk about that, because I dislike that even more than gold. This one is the ultimate equity destroyer. It had a little pop that got people excited on Thursday with some news, but it completely failed, and it continues to do what it does, which is to erode the value of accounts for people who are not understanding what this really is, and who are trading it. And again, it's just crazy that it trades 30 million shares a day, because it's nothing, and it's going to do another reverse split, and it will continue to do that, and it will continue to cost you money if you trade this thing. I hope everyone had a good week this past week. I will, like I said, I'm out of town until Tuesday afternoon, so have a good week, and I'll talk to you next time.